Hello and welcome to dissect here. In this video, we're embarking on a mini series of 5 videos where we're delving into some of the most significant financial scandals worldwide and their far-reaching impacts. Let's dive right in with a heavy hitter, the Enron scandal. Enron Corporation, a once respected American energy, commodities and services giant headquartered in Houston, Texas, had operations spanning over 40 countries. Little did the world know that a financial storm was brewing that would result in Enron's colossal bankruptcy and the implosion of its auditing partner, Arthur Andersen. Enron's grand vision of trading energy globally and managing risks across diverse markets ended up being its Achilles heel. Here's the twist. Enron's global ambitions became a breeding ground for issues. The company employed complex financial tactics to cloak its debts and losses. The intricacies of these maneuvers were baffling and difficult to regulate across various jurisdictions. This labyrinth structure made it almost impossible for investors to gauge Enron's actual financial health, and regulators struggled to keep tabs on their ever-evolving strategies. In the end, Enron's global dreams turned into its worst nightmare. Their intricate financial schemes unraveled, leaving them incapable of fulfilling their financial obligations. By December 2001, Enron was staring at bankruptcy, marking one of the most massive corporate meltdowns in US history. The Enron scandal truly kicked off in the late 1990s when they began dabbling in shady accounting practices. Here's a sneak peek into their playbook. Number 1. Mark-to-market accounting. Enron turned this method to value assets based on anticipated future earnings, not the actual present value. This creative accounting allowed them to inflate profits and present a rosier picture to the world. Number 2. Special purpose entities. Enron conjured up special entities to cover up debts and losses. The beauty? These entities didn't show up on Enron's financial reports, creating a facade of financial stability. Number 3. Off-the-books transactions. Enron engaged in these off-the-books dealings to mask even more of their debts and losses. Unfortunately, investors were left clueless about the real story behind the scenes. The truth finally came to light in 2001 when Enron announced a restatement of earnings for the past 4 years. Their stock price plummeted, leading the company to file for bankruptcy shortly after. The aftermath of the Enron scandal sent shockwaves globally. Investors, employees, and pensioners suffered losses amounting to billions of dollars. The scandal's ripple effects also led to the demise of Arthur Andersen, a major auditing firm. On a broader scale, the Enron bankruptcy rattled the energy industry. Investor confidence was shattered, leading to the downward spiral in energy stocks. Thousands of jobs were lost as Enron's operations stretched across 40 countries. In response to the debacle, a wave of regulatory changes was introduced to ensure history wouldn't repeat itself. The Sarbanes-Oxley Act of 2002, or SOX, is a US federal law introduced in response to the major corporate scandal. It enforces stricter standards for public companies, their management, and auditors to enhance transparency and accountability. SOX established the Public Company Accounting Oversight Board, or the PCAOB, to regulate audits, set internal control requirements for accurate financial reporting, and shield whistleblowers from retaliation. It holds CEOs and CFOs accountable for financial disclosures, enforces tougher penalties for frauds, and mandates codes of ethics to guide ethical conduct. Overall, SOX aims to prevent accounting scandals, restore investor confidence, and ensure integrity in financial markets. Over in India, the Enron scandal sent shockwaves that reverberated through the regulatory landscape. The three notable amendments were in the Companies Act 2013. This act introduced a number of new requirements for companies, including requirements for internal controls, independent audits, and whistleblowing. Number 2, in the Securities and Exchange Board of India, SEBI Act of 1992. This act was amended to give SEBI more powers to regulate the securities market and to investigate cases of fraud. Number 3 was in the Prevention of Money Laundering Act of 2002. This act was amended to include provisions for investigating and prosecuting cases of money laundering related to corporate fraud. So there you have it, the Enron scandal. It taught us that ethical practices, transparency, and robust regulation are the bedrock of a stable financial world. And while these reforms made a dent in the right direction, it's crucial to stay vigilant and keep adapting to stay ahead of potential financial crisis. If this video captivated you and you found it enlightening, don't forget to give it a thumbs up and share it with your circle. And hit that subscribe button for more captivating insights into the world of finance. See you in the next one.